Welcome to Module 28 of Accounting 5000. In Module 28, we're going to start on Chapter 15. We're going to do a little strange work on Chapter 15. We're going to do the beginning of the chapter and end of the chapter, and we're going to wait on the middle of the chapter to the next module. So what we're going to talk about at the beginning is, again, our budgeting, relating how we've come up with our standard costs and our budgets. And we're going to use that in the end of the chapter to look at how we evaluate parts of a company. Then in the next module, we're going to talk about the evaluation of the raw materials, direct labor, and variable and fixed overhead. So we're going to divide it up a little strangely, but I think if you follow along, you'll see that it makes a logical flow. So the first thing we're going to talk about in here is talking about why we do this evaluation process. Remember our little circles with all those arrows in it that will keep showing up on the slides, where we start out with a plan, we compare that with our actual, which is our control process, and then we make changes if we need to our new plan, and we go in a continual circle there, checking what we did against what we planned. What we do is called performance reporting. We're looking at our plan, comparing it to our actual activities, and if there's something wrong, we try to fix it. If it's going just as we planned or even better than we planned, we tend to leave it alone. But this is called performance reporting. And here's that wonderful little circle I was talking about. We talk about our plan, we come up with some actual activities that we're going to do. Then in the bottom corner of that slide there, it says performance analysis. We're going to look at our plan and our actual results. That will then feed back into our next cycle in planning. So what we've got to look at then is, what are our costs and what are we looking at? We want to look at what actually happened, and we can find that out by looking at the numbers that are generated by our cost accounting system and our management accounting system. We look at our budget, which we have on record because that's what we plan to do, and we compare the two. Now, one of the things we need to be aware of is that sometimes we plan to produce at a certain level, and we may produce at a level either higher or lower than that. So we need to adjust our comparison numbers to our actuals so that we can compare apples to apples. For example, if ETSU came up with a budget for educating 10,000 students, and something happened and we now had 15,000 students, it would not be very logical to compare what we'd planned in our budget for 10,000 students to what it cost us to educate 15,000 students. So we would have to adjust our budget, our plan, in order to take into consideration the fact that we have twice as many students as we had planned on having. To do that, we call a flexible budget into roll here. And what we do with a flexible budget is we adjust our variable costs. We leave our fixed costs alone because they don't change much depending on the quantity that we're producing. But we have to adjust all our variable costs, our raw materials, our labor, and our overhead, to take into account we produced more or less than we planned. So we're going to use a flexible budget to do that. Now what we're going to do is look at the costs. What costs were incurred in actual activity. Now you have to remember that a manager can't be responsible for every cost that's incurred. They're what we call non-controllable costs. A non-controllable cost is something the manager can't do anything about, at least not in the short run. Theoretically, in the long run, every cost is controllable by somebody. But in the short run, a manager, for example, a department head at a university, cannot control the cost of the salary of his employees. Not in the short run. In the long run, that is probably controllable. But in the short run, it's not. And there's some other examples like that. Controllable costs are those that they have some influence in getting to a certain level. Non-controllable costs are ones in which they either do not have the authority or they're not able to change them in the short run. So when we're looking at a performance evaluation for a manager, we do not want to include anything that's beyond his or her control. We only want to look at the controllable costs, and we want to compare apples to apples. We want to compare a budget based on what actually happened to the actual results that are reported by the cost accountant. So if you're looking at a performance report, what you're going to look at is something that's very similar to the bottom of this slide. You're going to look at a name of the activity, what the budget was, what the actual amount was, then the difference. Remember, variance is nothing but a difference. We're going to look at the difference, and then we're going to have that last one, which is an explanation of why that happened. What went on? Perhaps your raw materials cost more, so there was a variance in the cost side of raw materials. The explanation could be that inflation has hit the particular item that you're purchasing and the cost has gone up. Perhaps you had to change suppliers, so the cost went up. Perhaps you couldn't buy in the quantities that you did before, so you had to buy in smaller quantities, in which case the price went up again per unit. So you look at those things and you look at the explanations. You're looking at explanations for any differences. Now remember, a variance is just a difference, and it's either favorable or unfavorable, good or bad. Typically, you want favorable variances. You want things to go better than you'd planned, but often you have an unfavorable variance simply because of external factors. The workers you had to hire cost more because of the demand for workers in your area, so your direct labor cost went up. Or perhaps your new labor is unskilled and they need to learn their task. It's going to take them a while to get better at what they're doing, so it's taking you longer than you had planned to produce a product. Those things will play a role, but they're always in that explanation column of a performance report. So the manager will get this performance report. He or she will write down and explain all the things, pass it on to his or her manager. That manager then looks at the explanation, looks at all the variances, and passes it on up to higher and higher levels of management. As it goes up that chain of command, realize that the higher level managers really don't want to know everything in the detail that the lower level managers do, so it becomes consolidated, condensed, and only the big important items are actually reported further and further up. Lots of times we call that management by exception. They really only want to know what's going wrong, how they can help fix it, what can be done to make it right. So that's what we call management by exception. And this just cuts down on a manager's time, because all you really want to focus in on are things that you need to fix. You want to spend some time on the favorable variances to make sure things continue to be favorable, but you're not going to really emphasize those to the extent that you are your unfavorable variances. Typically these reports, these performance reports to managers, are produced as soon as possible after the year end or after the month end. They want to take them early, look at them, see what's wrong. They want to fix it as quickly as possible, and they don't want to forget what happened. So typically you try to do it within the week after the month ends or within the week or month after the year ends. So you have to try to make them as timely as possible. Make them as frequently as you can. Remember, we said we want to compare apples to apples. We want to use a flexible budget in our performance report. We want to show the activity, the budgeted amount in a flexible budget. We want to show the actual amount, any difference or variance, and then an explanation. And the flexible budget is what we use in our budgeting for analysis to see how management is performing. Well, how do we break this down? Well, typically what we do is we do it by segment of the company. In other words, we don't just do it for the company as a whole. We do it by each little piece of the company so that we can get a better feel for what's going on in each individual area. You don't lose information the more you break it down. So lots of times we do it by product line. If a company's making several different products, we do it by each particular product that's being produced. Sometimes we do it by unit. If there's a particular plant that's doing one thing and another plant that's doing another thing, we break it down that way. But when we're doing it, we do it by segment, and we use that old familiar contribution margin approach, where we take sales minus variable expenses, gives us contribution margin, we subtract out our fixed expenses, and we get operating income for each particular segment. Now, there should be one thing to note, and that's that last slide, the bullet on that last slide that said we do not use allocated fixed expenses in evaluating a segment. We only use the fixed expenses that relate to that particular segment of the company. There's some fixed expenses, like the president's salary, that most companies will just take and randomly divide up and say, oh, everybody gets a third of it, or everybody gets a tenth of it. But those are not controllable by that segment, by that manager. So he or she should not be responsible for that indirect fixed cost. Only the direct fixed costs, those that relate to the plant, the depreciation on that particular equipment, the insurance and taxes on that particular building, those things that can be related directly to the segment in the fixed cost area are the only ones that should be included. And those are called fixed costs by unit. Those are direct fixed costs, sometimes called segment fixed expenses. How do you determine those? If that whole area went away, would those fixed expenses go with them? For example, if you did away with that production plant, all the costs of that plant would disappear. You wouldn't have the taxes and insurance because you'd probably sell the building. If they go away, then they are direct fixed expenses. If they remain, for example, the president's salary is going to stay even if one of the plants goes out of business, then it's what we call a common fixed expense, and we do not allocate it because it'll still be there no matter what happens to that segment. Well, there are different kinds of segments within an organization. We talked about how we divide them up by product line or division or plant. Realize that we can classify each of these segments in three different categories. What we call a cost center, a revenue center, and a profits and an investment center. A cost center doesn't have any revenue. A cost center is usually a service part of the organization. For example, the HR department doesn't really generate any revenue, but it does have costs. So they're evaluated based on how well their budget compares to their cost budget. The second type of organization segment that we look at is called a profit center. And here we're looking at how a company's return compares to their return that was budgeted. For example, their expenses and their revenues. You compare both. The last one, which is an investment center, goes back to that famous ROI. Remember your return on investment? You're looking there at how well the company did on their ROI, which is the use of their assets, compared to their budgeted use of their assets. So you have different methods of evaluating. In a cost center, you just look at the costs. In the profit center, you can look at the contribution margin, just looking at revenues and expenses, evaluating those two. But when you get down to the investment center, where the company has some real assets involved and the manager has control of those assets, you're looking at ROI, which is a different piece entirely from the variances that we're going to be looking at in the next couple of segments. How do you evaluate these segments once you get the data produced? You look at the different things that are happening. Is the plan being executed the way you had wanted it to be? In other words, actuals compared to budget. In every case, actual compared to budget. Regardless of whether it's a cost center, an investment center, or a profit center, you're still looking at the same two pieces of information. It's just how you're looking at them, or what two pieces of information you're looking at. So let's see a little bit about how this works. Let's look at one of the exercises at the end of your chapter. Exercise 1. It's at the very top of page 556 of your textbook. And you have here a company called Buxton. The manager attended a seminar about the contribution margin. Remember, sales minus variable expenses gives you contribution margin. She came back to her company all excited about it, and she asked that they take their traditional income statement and revamp it and put it in a contribution margin approach format. That's given to you there in the middle of the problem in those two bars. The president was told that fixed expenses of $30,000 included $21,000 that had been split evenly between divisions because they were general corporate expenses. Those are what we call common fixed expenses, so they shouldn't be included in the analysis of each of those segments. The company looks at these statements and she says, I knew it. Division B is a drag on the whole company. Close it down. Well, if you look at the analysis they present there in the book, it appears that Division B is losing $1,000. You say, wait a minute, I'm an accountant. I know that you don't allocate common fixed expenses. So let's take it out. Let's look at what happens if we had just B without the without the allocated fixed expenses, but only the common fixed expenses. Let's see what happens. So in this slide, what we do, we take the contribution margin for the entire company, which is $40,000. We take out the fixed expenses that are only the common fixed expenses. We leave out the direct fixed expenses. We come up with a new net income of $4,000. So what does that tell you? It tells you that the company will be hurt if they do away with Division B because they are arbitrarily allocating fixed expenses. The net income for the company right now is $10,000. If they do away with B, it goes down. So there's no reason in the world why they would want to get rid of Division B. They've arbitrarily allocated those fixed expenses, which is a mistake. So be aware of that when you're working with a company and they ask you which segments are losing money. Only look at the revenues, the variable expenses, and the direct fixed expenses. Allocated fixed expenses are not relevant to your decision about how to evaluate a segment. Let's look at another one. Let's look at exercise 3. It's about a third of the way down, page 557. What you have here is the formula for the maintenance department of Hampstead Limited. Consists of $19,400 a month plus $7.70 per machine hour. They ask you to calculate the maintenance cost that would be budgeted for a month if they did 6,700 machine hours. So basically what you have is a flexible budget. The $19,400 is their fixed cost. The variable cost of $7.70 is the variable cost, and that's per unit. There's 6,700 units, so you simply take your 770, multiply it by 6,700, add that to your 19,400, so your flexible budget amount is $70,990. In Part B, they ask you to prepare a performance report if they had 7,060 machine hours and the maintenance cost was $68,940. So the first thing you do is produce your flexible budget amount, which is your fixed cost of $19,400 plus the $7.70 times the 7,060 units. That gives you a budgeted amount, flexible budget amount of $73,762. That's what you want to compare to the $68,940, which is your actual cost. And you can see they had a favorable variance of $4,822. So they did better than they had expected, better than their budget. Now that would not necessarily have been the true picture if they had not used a flexible budget. If they had budgeted based on, say, 6,700 hours and they produced 7,060, then you can see they would be comparing apples and oranges. So they've done the wise thing by using a flexible budget to adjust how they're going to compare 7,060 hours to the cost that should have been incurred at 7,060 hours. Let's do one more flexible budget to see what they look like. Let's look at exercise 4 right under there on page 557. Exercise 4, you have a company that makes one product. The original budget is based on 14,000 units. The actual production was 13,300. So now you don't want to take your 14,000 unit budget and compare it to the actuals for 13,300. So your job is to take the budget for 14,000 and fix it so that it would be an appropriate budget to compare with the actual expenses at 13,300. So to compare a performance report, remember what it looks like from that previous slide. We take the flexible budget, we compare it to actual cost, and we get a variance, and then we explain it. Well, for direct materials, here's what I did. The original budget was $220,500, but that was based on 14,000 units. So I took the $220,500, divided it by 14,000 units, and I came up with $15.75 per unit. I took that $15.75 and multiplied it by our 13,300 actual units and came up with a flexible budget of $209,475. Now that number, $209,475, is what we want to compare to our actual of $216,600. We still had an unfavorable variance, but it wasn't nearly as large as if we had compared it to our original budget, which was not a flexible budget amount. Let's do the same thing for direct labor. Our original budget for direct labor was $170,800, but that's based on 14,000 units. So divide that number by 14,000, and you get a cost per unit of $12.20. You take that $12.20 and multiply it by the 13,300 units they actually did, and your flexible budget amount is $162,260. That's what you compare to your actual cost of $165,400, and still, you get a variance that's not very good. You get a $3,140 unfavorable variance for direct labor. For variable overhead, you do the same thing. Original budget was $86,100 for 14,000 units, which is $6.15 a unit. Multiply that by 13,300, so your flexible budget amount would be $81,795. Your actual costs were $78,100, So in this case, you had a favorable variance. You had a good thing. Your costs were less than your budget by $3,695. In your fixed overhead, what you're going to do is take your original budget, $68,000. That won't change based on production. Your budget is your budget, $68,000. Your actual cost, though, is $69,000, so you had a $1,000 unfavorable variance there. And that would have occurred no matter how many units you made, because remember, fixed overhead doesn't change depending on the amount that you produce. So it wouldn't have made any difference whether you produce the same amount or not. So what we've done in this first part of the Chapter 15 is to look at segments, how we evaluate segments, and how we use a flexible budget to do that evaluation. What we're going to do in the next module is take the middle part of this chapter and look at how we evaluate direct labor, raw materials, variable and fixed overhead on a per unit basis. So we'll continue this chapter in the next module.